LiteFinance, the world of financial freedom.
It's a Monday 14th of August and it is time for the market forecast for this week. And so this time, apart from discussing major macro events and publications from the calendar, we will summarize the fundamentals that are driving the gold price. Okay, Monday is completely empty in terms of any macro event. Tuesday is rather busy. We will get Japan GDP, UK labor data, US core retail sales and Canadian CPI. On Wednesday, RBNZ will make their interest rate decision, where consensus of analysts predicts there will be no change. Next, we will get UK inflation data, Eurozone preliminary GDP figures, crude oil inventories, and the most important event of the week, which is publication of FOMC meeting minutes. On Thursday, we will get initial jobless claims from the US, and on Friday, UK retail sales and Eurozone final CPI. And that's about it in terms of the macro calendar. Now let's move on to fundamentals. So the Fed has found itself in unknown waters, so gold isn't feeling at ease. The central bank's pay for policy tightening has never been so low in the post-war history of the US economy. Victories over high prices are normally followed by unemployment growth. However, unemployment isn't rising in the current cycle, while its correlation with inflation points out that the current situation is unique. So the USA can count on a soft landing, which puts pressure on XAU-USD quotes. The fans of gold feel enthusiastic as Chinese gold reserves have grown for 9 consecutive months. They surged by 23 tons in June, 188 tons since November, and reached 2,137 tons. And so the XAU-USD bulls bet on the de-dollarization. So they think the US bond market is always right, and growing treasury yields mean the system is breaking down. The USA and the US dollar lost credibility, which is proved by the weak results of the 30-year treasury auction. The share allotted to primary dealers was the largest since February, indicating weak demand. And so conversely, the opponents of gold mention outflows from gold ETFs for 4 months in a row and discouraging work results of the mints. Gold ETFs reserves have shrunk by 34 tons, 87 tons since the beginning of the year. And so the United States mints sales fell by 3.5% month-on-month in July and 36% year-on-year. Still, traders' attention should be first and foremost drawn to the macroeconomic background and the Fed's monetary policy when gold acts as an investment portfolio instrument. So only then the physical asset market should be considered. So the Fed's aggressive monetary restrictions have not substantially cooled the labor market and the US economy, which is extremely important for the XAU-USD. Inflation/unemployment ratio is currently negative, other situation in the previous cycles. So the reasons vary, starting from the household's significant savings accumulation during the pandemic, supply disruptions as the main driver in the inflationary boost which is fading away, and ending by the lag effect of monetary restrictions on GDP. But the most important thing is that the longer the US labor market remains tolerant to Fed funds rate hikes, the later the Fed will ease policy. And so the market's current forecast is March 2024, but if the date shifts to later, the USD will consolidate and the XAU-USD will continue falling. So our stake on the US economy's strength and keeping borrowing costs on a plateau of 5.5% for a long time allowed us to exploit gold shorts. So the first target of 1,915 an ounce was reached. Use pullbacks to open shorts with a target of 1,818 and 850. And so that will be all from my side for today. Thank you for watching and I'll see you next week.